Well, let's now get to Aaron Smith, Managing Director at Superfund Financial, joining us now live on set. Aaron, thank you very much for joining us today. First of all, the bailout plan. I don't think anyone thinks it's going to be the silver bullet, the panacea that unfreezes the credit markets, that saves the equity markets, that basically helps out everybody's wallet right now. So what is it going to do?
Well, we do expect the bailout to get passed in some form in the near future, but this isn't going to solve all the market problems, as you point out. The big issue, if you think about it, the global market cap for equities right now is about $40 trillion. That's come down a few trillion in the past few weeks. But the global value of all the derivatives in the market is about $455 trillion. So that's obviously representing a huge amount of leverage that's still out there. And as financial institutions are reining in this leverage, this is like taking air out of a balloon. Either the balloon's going to pop or you slowly let the air out. So we're not sure which will happen, but we think the prognosis is quite bearish for stocks. And actually, if you're buying stocks long only at this point, it's, in my view, sort of a sophisticated form of gambling. But there's no reason to be too nervous. Investors could take advantage of the cheap prices in commodity markets and benefit substantially from that in the next 2 to 3 years.
Even in near term, people are talking about, I mean, we are in a global slowdown and the demand is coming off. For raw materials.
There's a lack of food on the planet today. There's less food than at any time in the past 100 years. People aren't going to stop driving cars, so there's going to be demand for energy. So even in the context of a global slowdown and stocks sort of coming off their highs, there will be...
People still need to eat?
Yeah, people need to eat, people need to get around. I mean, a good example is if you look at the Nikkei in Japan. In 1990, it peaked at 40,000. Today, it's trading around 11,000. Well, Japan's the second largest economy in the world and very, very productive. So it's just because there's production in the economy doesn't mean that there can't be a huge amount of risk in stocks.
Right, so because of the inherent risk in stocks, you wouldn't be getting in on commodities through commodity-related stocks like BHP. It would be through the commodities themselves.
If you have to buy stocks, it's better to have commodity stocks than financial stocks. But we believe that we're shifting to an era of real assets, where real assets will be valued more than paper assets, like stocks and bonds. So we want to have exposure to the real underlying commodity. The best one that investors could buy in this type of market environment today is gold.
So you're going to pick one, you're going to pick gold. So what would we'd be at by the end of the year? 1,000 again?
By the end of the year, I think gold easily goes to 1,000. If you look back 5 months ago when Bear Stearns went under, gold was over 1,000 just at that point. So we expect that gold can go to $1,500 per ounce in the next 2 to 3 years. But certainly if you have a long-term view, because of the weakness in the U.S. dollar, and because of prevailing inflation.
Because of the weakness in the U.S. dollar, so you think it's going to weaken again?
Absolutely. Amanda, there is tremendous downside potential in the U.S. dollar. Obviously, dollar has rallied in the past couple of weeks, which is a great opportunity for investors to cash out of their dollar assets, buy real commodities, especially gold. Because gold is going to protect you against inflation and has tremendous upside potential when the dollar is falling in the long run.
Interesting stuff, Aaron. Got to go. Great to talk to you, sir. Thank you for your time.
Thank you.
We've been talking to Aaron Smith there, excuse me, Managing Director at Superfund Financial here live on set with us. Let's